Hey everybody, Paul Moore here from Wellings Capital. So thankful that you joined us this evening, and we are going to get started in just a minute. So thanks for joining. It's 9 o'clock on May 28th, 2019. And if you're watching this live, we'll be starting out in just a minute, waiting for a few more people to join. If you're watching the recording, hang tight, and we are about to get started. Okay, everybody, welcome. Paul Moore from Wellings Capital here tonight, and we're going to talk about why a multifamily author is not investing in multifamily at the moment, but investing in one of real estate's most boring asset classes. I'm kidding. The yawn was a joke. Seriously, we want to talk about boring investing tonight, and I've been a serial entrepreneur for about 26 years now. And I think for years I confused investing and exciting entrepreneurism. I've talked many times before about the difference between investing and speculating. You know, investing, as I've said many times, is when your principal is generally safe and you've got a chance to make a return. Speculating is when your principal is not at all safe and you've got a chance to make a return. But there's another thing people get confused with. A lot of investors, a lot of entrepreneurs are the same people, and we think that our investments should be exciting. But there's a case to be made for why we should have exciting lives, why we should have exciting times with our family or serving our, our neighborhood or our society, or have exciting vacations, exciting fun times, exciting entrepreneurism, but boring investments. You know, Warren Buffett, I'm going through his biography. Ben and I are both going through Warren's biography right now. And he said, most of you won't imitate me. Someone said, why don't people just imitate you? And lots of people have tried. He said, because you don't want to get wealthy slowly. It's boring. You know, a lot of people think it is, but I've found over the years that I'm looking for investments that are not exciting, razzmatazz. I mean, there are some out there. You know, there's the story of the guy who put $1,000 into Facebook and now it's worth, X number of dollars, or a guy who did a painting for Facebook. He did some graphic art thing and now that's worth over $1 billion because he got a little share of the company that became a big share later. But we want to talk about boring investments tonight. So as you know, I wrote a book called The Perfect Investment about multifamily investing. But tonight we're going to talk about why we're investing in this so-called boring asset class called self-storage. Paul Samuelson said in his famous quote, investing should be like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. So I'm going to touch briefly on why we're not investing in multifamily at the moment. Demographics and long-term outlook are very strong. We really like that. The default rate in multifamily, like self-storage and mobile home parks, is almost zero. The space is significantly overheated, though. The cap rates are at record levels. There's a lot of 1031 exchange investors coming in, a lot of IRA investors coming into multifamily. There's international money coming in. There's institutional money. You know, it used to be the institutions used to stick to LA, Chicago, New York, Boston, San Francisco. Then they spread out to places like Seattle, Dallas, and Atlanta. And now they're investing in places like Omaha and Kansas City and Lexington, Kentucky. It's hard to compete with these guys because they're willing to accept a much lower return than most of us would want. There's also the Nuru impact. And as I've said recently, I've been trying to coin this phrase, Nurus, which is basically new gurus, people who weren't investing in real estate in the last recession a decade ago. And now they're telling us it's okay to overpay for commercial real estate, specifically multifamily, because it's so hot, it's going to keep going forever. But you know what, my friends? Trees don't grow to the sky. Everything has a cycle. And so we know that it's not different this time. It's not going to keep going up forever. That's impossible. And there's going to be a cycle. There's actually wolves in sheep's clothing. That's part of the problem too. I was actually at a conference in Miami, Florida, and a famous multifamily investor took the stage, and he said, hey, he said, go ahead and get into multifamily. Don't worry about overpaying. Just spend as much as you need to get in the game. And I thought he was kidding. I thought there was going to be a punchline, but there wasn't. And his quote went around the world, actually, on the online. And it's not okay. Warren Buffett doesn't think that way. You know, Howard Marks doesn't think that way. Great investors of all time don't think the way some of these gurus and sadly some of these wolves in sheep's clothing are thinking. These are the kind of guys who, you know, collect a fee. They collect a acquisition fee or a brokerage commission or something else, whether you make money as an investor or not. You know, be suspicious of anybody who only gets a transaction fee and doesn't have themselves completely aligned with you. So we love self-storage. And I'm kind of saying, you know, that it's a boring asset class, a little tongue in cheek. Some of the things we love about about self-storage is, number one, it's recession resistant. Think about it. In good times, people need a place to store more stuff. In bad times, they're downsizing and they need a place to store more stuff. And so the tenants are really sticky. I mean, if you think about it, if I raised your apartment rent or from $1,000 to say by 6%, you know, you're locking yourself in just $720, you know, $60 a month for 12 months. But if I raise your self-storage rent by 6%, you have a month-to-month contract. You're probably not going to take a Saturday and rent a U-Haul, get your friends together to move your treasures or your junk down the street just to save $6 per month. And that's the beauty of self-storage. It's a large and fragmented industry. About 75% of self-storage facilities, and there's about 53 to 54,000 of them in the US, which is the same as Subway, McDonald's, and Starbucks combined. About 75% are owned by individual operators, small-time operators, and about 66%, which is 88% of the 75%, are owned by one-off mom and pop operators. They don't know how to maximize income. They don't know how to drive value, and they don't care because they consider it a passive asset in many cases, a place to collect mailbox money from. And that's okay for them. But that's an opportunity for us, because if we can acquire a self-storage facility and run it as a business, which is like a quasi real estate, quasi retail operation, we can increase income dramatically and we can increase value even more because of leverage. And we'll talk about that a little more later. Now, I used to think, like I said, self-storage, you know, where's the value add opportunities? I mean, you know, it's 4 pieces of sheet metal, a door, and a slab of concrete, and some rivets. And how am I going to drive value there? It's not like there's cabinets, not like there's countertops and appliances and lighting and flooring and fixtures and doors and windows to upgrade. It's not like there's staging to be done. You don't stage a metal box. Where are the value adds? It's boring. But it's not true. There's lots of value adds. A lot of those are low cost value adds, like adding U-Haul. Adding U-Haul, and which basically is a change in policies and procedures, and adding $2,000 or $3,000 a month to the facility's income. Now that might not sound like much, but later we're going to talk about why that is a lot of money. And there's a lot of other value adds like that. Adding retail items like locks, boxes, scissors, and tape. Adding insurance, you know, you can sell insurance at a self-storage facility. You can charge admin fees and late fees. You can raise rents just like an airline or a hotel. You might be on an airline and sitting next to somebody who's paid twice as much as you did for their seat, and we accept that. Self-storage clients, very much different than multifamily, who know each other, they know their neighbors, they hang out. Not so at all with self-storage. They don't know their neighbors, and you can raise rents individually based on the type of client, based on their longevity, based on what they're storing, their motivations, all kinds of things that a smart operator can do to raise income at a self-storage facility. So it's a beautiful business, and the leverage effect makes it even better, because every dollar in increased income turns into multiple dollars in increased value. And we're going to talk about that in just a few minutes. The perfect business plan. I'm writing a book on self-storage right now, and there are three major business plans. One is ground up development. You got to be really careful these days, because the sector can be a little overheated, can be very overheated in certain locations. So ground up development's a higher risk, higher return strategy. Another strategy is a momentum play, where you just buy an existing self-storage facility and enjoy the income from it. I said there was three, there's four. There's a third strategy, which is conversion, converting a Kmart or a Walmart, an old Walmart, or a big box grocery store like a Kroger shut down. You can convert those. Sears stores have been converted. Toys R Us stores have been converted, and there's more coming. Now, some of you have heard the story. A friend of mine named AJ Osborne, he bought the Super Kmart in Reno, Nevada, and he, first of all, sold off the parking lot to an apartment developer. Then he cut the building in half, put a beautiful front on it, and he retrofitted the inside for climate controlled self-storage. Now AJ has $2.5 million in cash in this self-storage facility, and he has $5 million in debt. So he has $7.5 million total in it. He just got an offer in December for $25 million to sell the facility, and it was only about 40% occupied at the time. So that's about a 9x, ninefold return on his cash. It's a beautiful strategy. My favorite strategy, however, is another strategy, and that is basically buying a mom and pop facility and upgrading it dramatically, adding U-Haul and all those other ancillary income items, increasing the operations, increasing the income, and then selling it to an institutional buyer. I love AJ's story, but there's not that many opportunities like that out there. This is an opportunity that works really well. In fact, Wellings Capital is investing with a company who has done 21 of these mom and pop sellers upgrade to and selling to an institutional buyer 21 times, and they've been averaging an IRR, a return of over 40% on that at the investor level, much higher at the asset level. So it's a great strategy. It's a great business. It's something we're really excited to invest in. Now, the Real Estate Guys Radio, you guys might remember them. Today, they came out with an article, and it said, during the 2008 economic downturn, self-storage was the only REIT sector that posted a positive return of 5%, including dividends. We think that's kind of a big deal. That's a quote from Forbes magazine from November of 2017. They also said last year, Green Street Advisors, a real estate research group and advisory firm, reports that self-storage growth has outpaced any other type of real estate since 2011. In fact, Green Street says self-storage properties are up nearly 75% from the prior peak in 2007, outperforming even apartments, industrial, and commercial sectors. And we can see that in this graph. You can see here that same property net income growth for manufactured housing and self-storage are at the top of the heap. And those are both asset classes that we love here at Wellings Capital. Self-storage, according to the National Association of REITs, the self-storage sector produced the highest average return from 1994 to 2017. And if you study economics, you know that 1% increase in return is a big deal when you take it over 20 or 30 years. And so it is a big deal. Now, like I said, part of the reason this is such a fun business and not as boring as I originally advertised is that it's a fragmented business. The top 10 self-storage companies only have a small percentage of all the assets out there. And there's a lot out there, a lot of mom and pops, 40,000 mom and pops almost. And some of those are way out in the country and wouldn't be a good fit, but some of those are in the path of growth. So it's very exciting to be able to acquire from a mom and pop. And a lot of these mom and pops have, they have no online marketing presence. They have limited hours. They have no customer service to speak of, no showroom. One of them I met with not that long ago said they only take cash and checks. One of the great things about self-storage is people set it and forget it. They put it on their credit card or they debit their bank account and they continue to pay it month in, month out, year in and year out, and they forget about it. Well, if they have to write a check every month or bring cash down to the office, they're probably going to keep remembering it. So there's all kinds of things about mom and pops that make them great potential acquisitions. They say you make money when you buy. Well, you make money when you buy and when you operate and when you sell right. And that's our goal. Now, multifamily, the more so-called exciting asset class, 93% of multifamily are owned by 93% above 50 units are owned by operators, companies that own multiple facilities. Only 7% by so-called mom and pop or one-off operators, but very different in self-storage, very different in mobile home parks as well. So it's widely accepted that if you can put together a portfolio of assets and if you can sell to an institution, you can get a higher premium. You can get a cap rate compression. Now, the value formula we're going to talk about in a minute, basically you can get a lower denominator and therefore a higher value for your facility. And this is what a lot of our operators that we invest with love to do. Okay, so who's this? Jeff Bezos, one of the wealthiest, if not the wealthiest guy in the world, founder of Amazon. He went around and removed the light bulbs from all the vending machines at Amazon. And you may know why he did this. He said, well, why should I bother with these, advertising lamps or whatever the vending machine operator is? He said, it's wasting electricity. It's wasting the cost of a light bulb. It's wasting maintenance hours to replace these light bulbs. Why bother? You see, Jeff knows the value of a dollar. Now, one of our operators who's been at this about 42 years says he flies around at his own expense around the country every week going from facility to facility. And he says, I'm there trying to find dollars. I'm trying to pick up dollar bills. And the reason is $1 in commercial real estate is really powerful. There's a reason that the Forbes 400 wealthiest invest in commercial real estate. And here's a quick overview of why. Now, Jeff Bezos knows that if he can save $1 on his bottom line, there's a thing called a price to earnings ratio. Let's say it's 20-1. That means for every dollar he can save, it'll multiply into $20 in his stock price. And of course, a lot of that is his own wealth. What about $1 in commercial real estate? If you can save $1 or add $1 to your revenue, therefore adding $1 to the bottom line per month, that is $12 annually. Now, the value formula in commercial real estate is really powerful. And if you hear nothing else on this webinar this evening, please note this. The value formula is this: value equals income divided by rate of return. Specifically, the value of the asset equals the net operating income divided by the capitalization rate or the cap rate. If you can increase the income, the net operating income, that's the numerator, or compress the cap rate, the denominator, you can get a much higher value. It's called forcing appreciation. So $12 increased income divided by a, let's say, a 6% cap rate, which is fairly average these days. That means that $1 a month added to the income results in $200 in added asset value. It's powerful. $200 increased value. Now, it's better than that, because if you can use leverage, if you can actually borrow part of the cost of the facility, like my friend AJ borrowed $5 million and he only had $2.5 million in cash, it means the effect on the equity, the effect on the cash is multiplied, sometimes several times over. And so if you have a 60% loan to value ratio, that's a 2.5x impact on equity. It's very, very powerful and very exciting place to be. So I am going to check here, make sure we're all good on the screen here. Okay, so the power of a dollar in commercial real estate can be expressed in lots of different ways in self-storage. Let's say you had an acre of extra land at your self-storage facility and you had all the climate control, all the facilities you needed, and you want to do something with that acre. Well, you could pave it, fence it in, put a gate in, and you could actually lease it out for boat and RV storage. Well, an acre can be leased out for up to $10,000 a month, and we invested in another asset that has a similar story to this. So you could spend $100,000 putting together this paid outdoor storage, and you could result in leasing that for about $10,000 a month. That's $120,000 a year on a $100,000 investment. First of all, it's pretty great return, 120% per year. But think of this: if you divide the $120,000 per year by 6% or 0.06, that's a $2 million increased value. So if you bought a $5 million self-storage facility, $3 million of that's debt, $2 million of that's equity. This one change could actually, over a couple years while you're leasing it up, potentially result in a $2 million increased value. You double the value of your equity. Very, very powerful. What else could you do? You could raise under market rents by 20%. If you do that, a whole lot of self-storage mom and pop operators are under market on their rents. You can raise it by 20%. And there's a massive leverage effect in a couple different ways. One way is this: you're not increasing the cost, but you're increasing the revenue. And therefore, you're increasing your income disproportionately. But then when you take leverage into effect and the value formula, it's even more disproportionate on the value of the facility. Adding U-Haul, I mentioned that earlier. I know a facility that gets $5,000 a month in increased net operating income from their U-Haul. But let's say you could add $2,000 a month. $2,000 a month, $24,000 a year, divide that by 6%, multiply that by the leverage effect. You're talking about hundreds of thousands of dollars of increased value just by adding that, or adding point of sale items that I talked about before, or late fees and insurance. It's a powerful strategy. Value adds in self-storage. Again, it may seem boring, but the check that a lot of investors get in their mailbox is not boring at all. And this is a slide I borrowed from another presentation about mobile home parks. You see manufactured housing only had 3.6% of revenue is spent on their expenses, but look at self-storage. It's only 1.1% higher, 4.7%. And it's only a fraction of multifamily at over 12%. We love self-storage. We love manufactured housing communities. And we we are investing in operators. Wellings Capital strategy is to invest in best-in-class operators who have been doing this for a long, long time. This is one of the operators, their track record, they have assets all over the United States, and we love investing with them. Borrowing a few slides here, this is a recent investment, I should have said. And I believe this is in Aurora, Colorado, beautiful new self-storage facility that we are investing in. This is another one in Austin, Texas. This actually looks like an artist rendering, but it's not. It's that clean, it's that beautiful. So we love self-storage. We love the so-called boring nature of investing in self-storage, and we would invite you to join us to learn more. If you want to learn more, you can schedule a follow-up call by joining us on, typing in that Calendly link, and you can join me for a phone call or a video call if you like. You can also register on Wellings Capital's website to see all of our documents, or you can email us at info@wellingscapital.com. You can also give us a call at 1-800-844-2188. So I am going to leave this slide up for a few minutes. I'm going to do my best to check out questions. If you have questions, please put them in the questions box now. I'm going to wait a few minutes. It's about 9:27 Eastern as I'm doing this live. And so I'm going to look for any questions you have. And when I get through the questions, we are going to wrap this up. So, okay, a question is, where do you get the 6% cap rate? So historically, cap rates, capitalization rates, expected rates of return hovered around 8%. I just saw a self-storage cap rate article the other day from the 90s that were talking about a 10% cap rate. That means investors expected a 10% return on their investment. Well, then it became like an 8% return. Well, they're down to like 6% now. In fact, one of our operators just sold several assets to an institutional investor, and they averaged 4.5%. That's what they sold at, which means it was a very, very high price that they got. Because remember, the numerator, the denominator, a small denominator means a large value. And so pretty powerful to be able to sell. And we estimate a 6 or 7% cap rate for most of the estimates we do. However, the beauty is that lately the sales have been in the much lower percent, let's say the 5.5% cap rate on average for many sales that these operators we invest with are doing. Now, our funds just began in January, so we don't have any sales yet, but when we do, we're estimating a cap rate in the 6 or 7% range, but the operators have been seeing much better results than that. Somebody asked, what are the estimated returns? Thank you. So we have a growth fund, and the growth fund is all about increasing value, doing steep value adds, some ground up development. The estimated returns in the growth fund are 19%, and that's 19% annually. There's no scheduled distributions there. There is just growth. We're trying to emulate Buffett and continue to keep plowing back investments and returns to try to increase the overall return. There's about a 7-year window there. The income fund, which also has self-storage, but also mobile home parks, and theoretically multifamily when we can find good deals that make sense. The income fund is targeting a 15% total annual return. And we expect that to be tax advantaged return. Someone asked, are there opportunities for bonus depreciation via a cost segregation study like there is in multifamily? I could give you a really long answer on that, but I'll tell you yes. a lot of self-storage facilities. So self-storage facilities have a 39-year straight line depreciation method, but some of the components inside self-storage can be depreciated much more quickly, like lighting, some electrical components, like the parking lot, which is a 15-year asset, like the stripes in the parking lot and the asphalt, and the landscaping is a much shorter time frame even. So yes, it does often make sense to do a cost segregation study and accelerate depreciation. Now, you didn't ask this, but I'll tell you that there's other assets that we invest in, including mobile home parks, that have even a better depreciation schedule than self-storage. So it makes it likely that if tax laws don't change, that our investors, especially in the income fund, won't be seeing a positive number on their K1s, even though they'll be getting a check in their mailbox. By the way, the income fund has a goal of refinancing the assets in about 4 to 6 years, giving our investors back their principal, but allowing them to stay involved in getting returns in the income fund. So thank you for that question. Someone said, what is the recommended loan to value ratio when acquiring a self-storage facility? Great question. By the way, I want to ask you, please put your questions in the question box if you have any more. We'd love to get those answered this evening. We're going to wrap up in about 5 minutes if we don't have any more questions. What's the recommended loan to value ratio when acquiring a self-storage facility? Well, you know, it's fairly similar to multifamily and other asset classes. There are lenders, that view self-storage, mobile home parks, multifamily so positively that they would allow a loan to value ratio especially on a new construction of up to 85%. We think that's quite risky. So our target for Wellings Capital is to invest with operators. We're investing with best-in-class operators that would try to target about a 70% loan to value ratio or less. And so typically the operators we've invested with have often had a 60% loan to value ratio. One of our large top operators right now has a loan to value ratio that's even less than that. They're actually averaging a much lower loan to value ratio than even the 70% limit or the 60% target. So I would say 60, 70% would be a good target. So please input your questions. I got another one here. What is the source of debt for self-storage? Local banks, Fannie, Freddie, gonna have to get my glasses on, life companies, etc. And are they recourse or non-recourse? All the above. So there is a community bank called Live Oak Bank out of South or North Carolina. They do a lot of SBA loans, small business administration loans for self-storage. There are other community banks that do them. Banks like BB&T, which is really big in the southeast of the US, they do a lot of these. But there are also REITs that provide self-storage facility loans. For example, the REIT that owns U-Haul also provides loans for self-storage facilities. And so that would be an example. Fannie and Freddie they also do loans for self-storage. It's not used quite as much. Fannie and Freddie do a lot of loans for mobile home parks, however, which we love as well. Okay, any other questions about self-storage? Any other questions about anything I've said this evening? The value form, we talked about the value formula. We talked about having boring investments. We talked about all the value add opportunities. We talked about 4 different strategies in self-storage. And I can tell you that I wish we would have discovered self-storage earlier, but we are so glad to be part of it now. So before I wrap up, let me see if there's any more questions. Okay, what are your opinions about oversupply and self-storage? Thank you. Great question. I think it's a very serious issue. You've got to know, you really, if you're going to buy or invest in self-storage, you're really going to want to ask hard questions. There is software out there that you can use to see if you're in an oversupplied situation. I'm going to be in Charlotte, North Carolina, meeting with investors tomorrow. And in Charlotte, there was a self-storage facility that was a ground-up development. They were targeting a $9 million value when it got to stabilization, which would be about 90% occupancy. Well, it was going really, really slow. And a couple years into this, they were still nowhere near 90% occupied. And they realized, even when we get up to full occupancy, we're going to be underwater. We're going to be way less than our 9 million. And this facility's in trouble. What did they do wrong? They built right in the middle of a bunch of other facilities. It's not a situation where if you build it, they will come. It used to be that way, but it's not that way anymore. And it's really, really important that you know who you're investing in, where you're investing, who you're investing with, what kind of financial structure they have. And that's what we at Wellings Capital are doing. We are doing a lot of due diligence, finding best-in-class operators, asking hard questions, and our goal is to provide our investors with situations where they're not in an oversupply situation. I told you about the deal in Charlotte. Let me tell you about another one in Ramsey, Minneapolis, Minnesota area. It's an area called Ramsey, actually. It's a fast-growing suburb northwest of Minneapolis. And the zoning at this point makes all self-storage facilities have to be located in industrial parks, which is not a great place at all to be located. But the self-storage facility that we are investing in was grandfathered in. They're building on Ramsey Boulevard, right in the middle of Ramsey. There are multifamily, there's townhomes, apartments, single-family homes all around the area, and we feel like they're really insulated. The average self-storage square footage number per person in a 3 to 5 mile radius in the US is about 7 square feet per person. They're in an area where there's only about 2 or 3 square feet per person in that radius, and hardly any of it's nice, hardly any of it's well located, hardly any of it is climate controlled. So they're building a beautiful new ground up self-storage facility. It's an experienced operator. We're very excited to invest with them in our growth fund. Now, in our income fund, we recently invested in an asset in Greenville, South Carolina, which is a booming area in South Carolina, and one of the top cities in the US to live in. And it's also got a good deal of insulation from competitors, and it's already profitable day one, and that's why it fit in our income fund rather than our growth fund. And so somebody asked, how formidable are you in competing with national institutions, and do you just plan for sale to such institutions later? Yeah, some of these institutional investors are really sharp. So public storage is by far the 100-pound gorilla in this arena, and they own a large part of the market. We've also got Smart Shop and World Class Capital Group and Safeguard, Storage Smart, Morningstar Properties. They're based in Charlotte. There's a lot of these operators that do a great job. So our goal is to basically invest with folks who are able to acquire a well-located mom and pop, upgrade it, and get it ready to sell to these institutionals. Now, if we are buying or investing in an operation right next to a lot of these institutionals, that's going to be a big deal. We're probably not going to want to invest there. Now, on one hand, it shows it's a great location because the institutionals are coming. On the other hand, they have the ability, they have the bank account size to be able to drive competitors out of business. And actually that's well known as a strategy to, drive these mom and pops out of business. So that's something we definitely want to take into account. So thank you so much for joining us. Ben and I are super grateful that you joined us here this evening, and we are glad that you took the time out of your busy schedule, stayed up late to watch this webinar. Like I said, if you want to get a hold of us, give us a call, 1-800-844-2188, or email us info@wellingscapital.com. We really appreciate you all, and really hope you have a wonderful evening, and we'll talk again soon. Thanks.